So if you're filing your taxes at the end of the year and you're finding that you're paying way too much to the IRS, then one of the most substantial tax write-offs that you can implement is owning a short-term rental, a vacation home. And you can Google it. It's called the short-term rental tax loophole, so you can know that I'm not making this up. But in this video, I'm going to explain how this works because there are specific things that you need to know in order to implement this. And then I'm going to share with you an example of one of the properties that we're using this year, that we're kind of putting through this process of this short-term rental loophole, and it's going to relate to a substantial write-off for us against our active income. This is not against passive income, it's against your active income. So if you're working a W-2 job, you can write off these fake losses or these paper losses from your short-term rental against your active income. I'm Kirby Atwell, and I help people find, buy, and set up their first really high cash flowing short-term rental. I work with people personally through that process. So if you're interested in working with me on that, you can set up a call with me at the link that just popped up. It's livingoffrentals.com/call, and I'll take you to a quick questionnaire, and then you can have access to my calendar and set up a time that works for you, and we can talk through the details of that program. So why is this short-term rental tax loophole so powerful when it comes to writing off your taxable income? Well, first, let's talk about real estate in general and why owning rental properties is just a great strategy from a tax perspective. So the IRS wants to encourage people to own property by allowing you to write off the value of that property over time. So in other words, if you own a property that's a $100,000 property, over a period of time, they're going to allow you to write off or take a percentage of that $100,000 value and offset against your income that's coming in. And so they give you options on this. You can just say, okay, it's worth $100,000, and over the next 27 and a half years, I'm just going to divide the value of that $100,000 property, and then every year take a little bit of that value and write it off against my income. So that's called straight line depreciation. The other option is what they allow you to do is it's called a cost-segregation study. And all that means is that somebody comes in, looks at your property, and they say, okay, there's some components that are going to wear out much slower, and the IRS allows you to write those off over a long period of time, but then there's other components like appliances or maybe flooring or some of these other things that are going to wear out quicker than the more structural components of the property. And so the IRS actually allows you to depreciate those over a much faster period of time. And there's something called bonus depreciation right now where you can upfront take a bunch of those materials and depreciate them all upfront in the first year. And so that's the benefit of this cost segregation study. So now let's talk about the difference between long-term rentals and short-term rentals. So if you own a long-term rental, you can still do that cost segregation study. You can upfront depreciate a whole bunch of the value of that against income, but they don't allow you to offset it against your active income because that property for a long-term rental, it's considered a passive property. And so those are passive losses, and you can't offset passive losses against active income. So this can be really frustrating for somebody who works a W-2 job and makes really good money over here, and then they own these long-term rentals and they can't use any of those losses from their long-term rentals against their active W-2 income. So here's where the big benefit comes in with short-term rentals. So short-term rentals aren't considered passive, they're considered more active. And so the losses from your short-term rentals can be used to offset your active W-2 income. So that's the huge benefit. So you can still do that cost segregation study, you can still bonus depreciate up front a whole bunch of the value of that property, and so it's a big paper write-off that you can use to offset your W-2 income. So there's a couple key stipulations that the IRS lays out if you own an investment property that you use as a vacation rental and you want to offset your active income against the losses from that property or the paper losses or the depreciation. And what the IRS says is that the main thing is you have to materially participate in the activities around that short-term rental, around that vacation rental. So what does that mean? You have to materially participate. So the IRS lays out there's 7 different ways to be considered materially participating. So as long as you meet one of these criteria, one of the 7, then you are considered materially participating. And most investors focus on 2 of these. There's some that are kind of esoteric. They don't really apply to most people, but there's 2 that are pretty easy thresholds to meet if you do a little bit of planning. So the first one is that you participate in the activity of that short-term rental at least 500 hours throughout the entire year. So that's one that you could focus on and get to a place of 500 hours total. And then you are materially participating. That could be a kind of a high bar to set. You know, you might not participate 500 hours a year. They also allow you to participate for 100 hours during that tax year, and then those 100 hours have to be at least as much as any other individual, including individuals who didn't own any interest in the activity for the year. So as long as you participate in the activities surrounding that short-term rental at least 100 hours per year, and that 100 hours is at least as much as anyone else participated, then you're considered substantially participating. What does that mean? What is the 100 hours? What constitutes an hour's worth of work on your short-term rental? And that's the big question that comes up, and the IRS is purposely vague here. They don't give you a defined definition, so sometimes it can be up to interpretation, and it's always good to talk to your tax professional about this. But what the IRS says, it's in section 469C7 of the IRS code. It says any of the following activities would qualify as material participation. So real property development, so building, redevelopment, so rehabbing a property, construction, reconstruction, acquisitions, the time you're, purchasing the property, all that time, conversion, rental operations, management, leasing, brokerage, trade, or business. So that's a lot right there. It gives you this broad definition of a lot of different activities. So let's just say, as an example, you own an Airbnb or a short-term rental, and you are going through the process of buying the property. That time counts. You're going through the process of rehabbing a property or setting it up. That time counts. You're taking bookings from different guests. You're lining up cleaners to go in. You're lining up your handyman. All these activities throughout the entire year really add up. And as long as it hits 100 hours, and that 100 hours is not less than anyone else, any other single person has done in your business or activities around the short-term rental, then you qualify as materially participating. So I want to show you what this looks like as a real-world example of a deal that we just recently finished this year and what that's going to relate to in terms of tax write-offs for us. So if I switch over to my screen here, you can see this is a property that we bought at the beginning of the year. We rehabbed it, did a full gut rehab on this property. It's a 2-unit property. Both units are being used as short-term rentals. We fully furnished the property, and it's all set up, and people are booking it now, and it's making us some good money. So we decided to have a cost segregation done on this property, and this is the exact report that I got back yesterday. They just finished the cost segregation study yesterday, December 18th. Today is the 19th when I'm recording this, and this is what it's going to translate to in terms of tax savings on our 2024 tax return. And so when you start this process, what happens is typically the person who's going to do the cost segregation study looks at your general information and says, here's kind of the range of tax savings that I would expect from doing this cost segregation study. And so that way you can decide, do I want to pay for a cost segregation study to be done? Is the tax savings going to be worth it or not? And so in this case, it definitely was worth it. I can show you what it's going to translate to. We went with US Tax Advisors Group. You can see here what that company we're using. They charged me we did 3 properties total this year. This is one of them. Each one was just under $1,000 for the whole study. So you'll find pricing anywhere from a couple $100. Typically, you're going to do a lot of the work yourself in that situation, to tens of thousands of dollars if it's a super complicated property or a massive property. But as a 2-unit property, it's fairly straightforward. And so this is what it looks like. So in here, in the report, it shows that we bought the property for $145,000. The land, you can't depreciate land, just the structure on the land. So they subtract out the land, which is $29,000. That's the value of the land, or an estimate of what that value is. So there's $116,000 left. Then we put in $238,000 into the rehab. So we did, like I said, a full gut rehab on this property. And so we've got like $350,000 into the structure itself, not including the land. So then you can go down and you can see there's 2 tables here. And this is how they break it down. So they break down what part of the building, or the value of the building, is going to be depreciated over 27.5 years, over 5 years, over 7 years, or over 15 years. And then they figure out how much of that they can bonus depreciate in year 1. So they can take part of that amount and they can upfront bonus depreciate that in year 1, which is the big tax savings that we'll get in 2024. So they did that for the purchase, the structure that I purchased, and then also for all of the rehab that we did to the property as well. And so you can see at the bottom of the report here, it says, based on the results of the analysis, the owner can realize $53,674 in depreciation deductions on their 2024 tax filing compared to the tax return had cost segregation not been utilized. So if we hadn't utilized this cost segregation study and just done the straight line, we would basically be paying or have $53,000 less of a write-off on our 2024 tax returns. So it can be a substantial amount. So like I said, we're all in on this property for, close to $400,000 minus your, it was like $375, minus your land value. So it's not a super, super expensive high-end property, but we're still realizing a pretty significant tax savings. And since we had two other ones as well, we're going to combine those cost segregation studies to it, and it's going to write off or cancel out a significant amount of our taxes. So I'll put the person's contact information that we worked with at US Tax Advisor Group in the description below. His name is Carlos. I'm not affiliated or linked to him in any way, but he did a great job for us, so I like sharing great resources with others. And, obviously for 2024, it's probably late if you don't have a short-term rental to try to get a short-term rental to write off against your 2024 taxes. But if you're looking at your 2024 taxes and you're going, man, I'm paying a significant amount to the IRS, and I'd love to be in a position next year when I'm filing my 2025 taxes to not potentially be paying anything in taxes to the IRS. I've seen this time and time again, especially with high income earners, write off every penny of taxes against their W-2 income. So you could maybe a doctor or somebody working in tech or somebody, an attorney or an engineer who's making some great money and sometimes paying six figures in taxes. Instead, they go out and they find a nice 4-unit property that's, say, a $800,000 property that still cash flows really well as a short-term rental, and they do a cost segregation and it wipes out all their taxable income for that year. So that's very doable. If you'd like to work with me, like I mentioned, I help people through that process of finding, buying, and setting up their first really high cash flowing short-term rental that can cash flow, bring in extra income, and relate to significant tax savings at the end of the year as well. So I walk you through that entire process personally. If you're interested in that, you can set up a call with me at the link that just popped up. Thanks a lot for joining me for this video. I know your time is valuable. And if you got something out of it, hit the like button, share it with a friend who might be able to use this strategy as well. God bless, and I'll see you in the next video.